Past performance is no guarantee of future results. Content is offered for information purposes only. Unless stated otherwise, any and all individuals participating in the video are third parties that include both professional investors and individual investors who may not be licensed or certified by any institute or regulatory body. Unless stated otherwise, the views or opinions expressed may not reflect those of Seeking Alpha as a whole. The accuracy and completeness of content shared cannot be guaranteed. Seeking Alpha does not take account of your objectives or financial situation and does not offer any personalized investment advice. Seeking Alpha is not a licensed securities dealer, broker, U.S. investment advisor, or investment bank. Hey everyone, Daniel Snyder. Welcome back for another episode of ETF Spotlight. Today we are joined by Vance Howard. We are going to dive into the QQH ETF here from Howard Capital Management. He is the CEO and portfolio manager, so we can't thank him enough for taking the time today. Vance, how you doing?
Good. How are you?
Doing well. I want to dive right in, as we always do. The QQH, it follows this HCM Defender 100 Index. Or that's the ETF, right? So what is this fund? How did you create it? Kind of give us the baseline of what investors should know about the ETF.
Well, QQH is a very unique ETF, and we developed it to be defensive in nature because it follows the HCM Buyline. So we can go 0 to about almost 60% plus in cash. It could go 100% in cash depending on some different metrics that can take place. But what we wanted to do is mirror the NASDAQ 100, or mainly the QQQ. So we wanted to mainly mirror that index, but we can trade 20% of another ETF. In other words, we can be 80% QQQ, but 20% of another ETF. And the way we use that is we can either use the Qs on sales, or we can use an enhanced ETF, such as QLD, which is double leveraged up, so that we can add additional alpha to the portfolio in times that the market's trending very, very strongly to pick up additional gains on behalf of our clients. And you have to remember, the HCM Buyline is the backbone of QQH, and it is a trend indicator. And it's got a 68% win ratio, a 32% loss ratio. In other words, it's going to be 68% right, and then 32% of the time it's going to be wrong. Really get whipsawed. And that's what happens with trend indicators. You get whipsawed. If you don't want to get whipsawed, don't trade the markets, go get a CD. But that's how it goes. But what we wanted to build into trade the NASDAQ 100 was a defensive mechanism with things like the pandemic. Because QQH did wonderful during the pandemic. At the height of that, we were 65% in cash and only 35% invested. It made a huge impact on saving our clients the nastiness of the market. This year, because the whipsaw, we're a little bit behind it, and that's okay. We know that 32% of the time that's going to happen with a trend indicator. But what we did with the enhancement of the 20%, even if we're 4 or 5 points behind it, we can leverage up to 140 of the QQQ, and we can catch it. So even if we get behind it for a short period of time, a longer period of time, then we're going to do very, very well. So it's got mechanisms in there to reduce exposure to negative markets and try to reduce risk and volatility, but it's also got mechanisms when the market's trending strong to outperform. So we can do those two equations on behalf of of our clients.
Now, you said this thing moves fast. Are we talking about a daily rebalance, weekly rebalance, monthly, quarterly? How fast are we talking about here?
Well, I don't know if I said fast, but what we can do is reduce exposure in bad markets. In other words, the trend doesn't change that often. We've only had 3 or 4 trend changes since we started it, which was about 5 or 6 years ago. So we went through the pandemic. We've gone through this last nasty April, which was incredibly volatile, and it was incredibly hard to trade, just straight down and straight up, which is, any trend indicator is going to get whipsawed a little bit in a market like that. So that's the reason we enhance the portfolio, is when the trend's back up, we can catch it again. So if we're behind 4 or 5 points, then we can catch the market, rally past it.
Now, the Buyline trend strategy that you're talking about, some investors may not understand, okay, are you looking at a point on the screen that says everything should be bought right now? Should we leverage up at the triple Qs, or should we sell everything and maybe even go short? How should investors be thinking about a Buyline strategy if they're not familiar with that?
The HCM Buyline is a proprietary trend indicator of ours. And what we've done is we've averaged multiple indexes together to let us know what the trend of the market is with a non-emotional mechanical mechanism. Now, look, as you well know, Daniel, a trend indicator won't call a top and bottom. It's going to have to be sell off, 8, 10, 12% before the trend's ever going to change. So volatility doesn't really affect the portfolio unless we get a trend change. The same thing if you sell out, you need the trend to move back up. So it's not going to call a bottom either. the market's going to move back to some degree before you're going to re-enter with risk to go ahead and start taking advantage of a new uptrend. But I tell people all the time, you don't want to fight the trend. You don't want to fight the Fed. You don't want to fight the trend. That's just the way it is. And if you're looking for perfection, you need to go to the stock exchange in heaven, because they don't make it here. We're not perfect. They don't have a perfect trader. They don't have a perfect hedge fund. They don't have a perfect anything. You just have to have a very good, solid, predictable indicator that has a statistical edge over a period of time to win. That doesn't mean you're going to win every day, because you're not. Nobody is. Doesn't mean you're going to win every quarter, because you're not. Nobody does. But over a period of time, 3, 5, 6 years, you should do very, very well with a good trend system.
So we're talking about these momentum moves, right? As you're talking about not catching the top, not catching the bottom, but watching that momentum shift, maybe riding the wave, as some people like to call it. So these investors that are hearing about this, it's kind of quant approach, right? You're following this mathematical model that you've created that's proprietary to you. And the investors that are skeptical and maybe not willing to trust that as much right now, what would you share with them?
Well, what I would share with them is a lot of people forget how bad markets can get and why you want to be on the right side of the trend. People forget because most people didn't trade through 2000 to 2002. There was 36-month bear market. And what people don't do the math on is the NASDAQ was down 72%. In other words, if you put $1 million in the NASDAQ 100, you were down to about $240,000. Most people can't tolerate that. And that's one reason a trend indicator is incredibly important, because we are going to get another market like that one day, Daniel. I know we are. You know we are. Everybody knows we are. Markets do that. We're going to get another pandemic. Only think about another pandemic. What if it's not short-lived like that bear market was of 6 weeks? What is it, 6 years? You're going to want the trend to be on your side to try to protect capital as much as you can. And one thing about the buy line, as long as it's positive, we buy on every pullback. As long as it's every pullback we buy on, like this event here that's going on in Iran, it is what it is, but we're not going, the trend's still up. So just let it happen, let it roll over. Because a lot of times these markets, like with Iran, they're very short-lived. As short as 1 or 2 or 3 days. I mean, he bombs Iran on Saturday, and here we are in the markets looking like it may end up today. It's amazing.
Yeah, it's uncertain times, as we've been very in tune with. So kind of for the people that I know somebody's watching right now going, well, okay, well, obviously it's been a volatile year between tariffs and geopolitical risks and unrest and everything going on. So could you share any insights of, have we seen momentum shifts in your model so far this year? Have you seen those a period of time where a pullback may have happened where you didn't buy right away?
No, the trend's got to change. We're going to follow the buy line to the T. And that's what people hire us to do, is trade a system. They don't hire us to guess at this. The buy line's positive. We're going to buy on every pullback. When it goes negative, we have metrics of how much we take off as it weakens up. And when the buy line ends up being positive, we put it right back on. And we let the market do all the heavy lifting.
Okay, so now let's talk about returns, right? Over the last 3-year returns, you're north of 70%. And as you alluded to earlier in the conversation, I looked this morning, the fund's just down a little over 5%. I think it's 5.5%, not horrible for the year. But how should investors interpret the model of, we watched the bear market, as you were talking about earlier, in 2022, and how the fund performed. And now you've seen the bull markets, and you're capturing the upside and with that leverage effect that you're referring to. So in this period of kind of a whipsaw where it's kind of a sideways market, let's be honest. Sure, there was the sharp pullback, but if you take that out as an outlier, it's kind of a sideways market. How does the fund kind of perform in sideways times?
Sideways markets can do about what the market does. As long as the buy line is positive, it's sort of going to kind of mirror what the NASDAQ 100 or the Qs do. If they're sideways, we're going to be sideways. And that's going to be sort of the way it is with most investors, unless you pick that one stock and concentrate your portfolio on that one stock to really make an impact. And, like when Tesla did so well, if you're like Ron Barron, he did very, very well with Tesla, but now he's really kind of, for the past 2.5 years, Tesla's done nothing. He's got 47% of his equity in one stock. Well, he's kind of doing what Tesla's doing, which that doesn't mean 3 years from now he won't explode through the roof. I don't know. Neither does anybody else. But by trading the index, it gives us a way to spread our risk out. We're really just trading an index, but it gives us a way to reduce exposure in uncertain times like pandemics, like 2000, 2002, even in this volatile tariffs. What if it hadn't come back? What if it had continued to drop? So these things we don't know. Nobody knows what's going to happen tomorrow. And I think that's why the trend is so important. Is it perfect? No. But I think the trend is very, very valuable to reduce emotions even with what's happening with Iran. I mean, who would have known that we'd be up here on a Monday morning after he drops 3 bunker blasters and knocked the britches off those people? I mean, it's kind of amazing.
Yeah, it makes people turn their heads and
It does.
feel like they can't really understand what the markets are doing. So that's why we're all here, obviously, having conversations like this. But so, turnover of this fund, though, is north of 120%. You got an expense ratio over 100 basis points. Investors are always asking me whenever we do these interviews, you got to ask about the expense ratio. You got to talk about turnover. So maybe you can just share a little bit of, words about why the fund is at these metrics and why it's warranted for the buy line and everything that you're doing.
Turnover is going to add up because when you look at 2022, you look at the pandemic, you look at when we reduced exposure during the April sell-off, well, that's going to increase turnover dramatically. If we don't have those nasty sell-offs, and turnover is very low. As far as our expense ratio goes, Danny, you can go look on Morningstar. Since inception to date, we're leading the pack. We're beating all of our indexes, So if you grade us on a 1 month basis in April, maybe you grade us low. Grade us from inception to now, you got to grade us high because we're leading the pack. We're beating the indexes.
Thank you for that. All right, before we get out of here, I got to ask you personally. I mean, I know this is a fund that tracks your model, but we're talking about the tech space. People love the tech space. They love the growth. They love to see what's going on in the world of AI. Wanted to see if you had any personal thoughts on the world of technology and where it might be heading from here.
Well, people call me crazy because I'm on different programs and I don't know, I won't mention them because sometimes other people don't like talking about the programs. Long story short is I think the S&P is going to go dramatically higher over the next 3, 5, and 10 years. I think you could see the S&P maybe even double in 36 to 48 months if things really take off. And people say, well, that's a really bold call. I don't think that it is. I mean, if you look at deregulation, you look at what's going on with our economy over here, you look at the fact that you've only got 3,500 stocks in the Russell 5000, there's less and less stocks to even buy. So either you put your money in a business, you put your money in real estate, or you put your money in stocks and bonds. There's where your investments are going to go. Most people don't want to deal with real estate. You got the 3 T's, taxes, toilets, and tenants. They don't want to deal with that. They'd rather just buy good, solid equity. And you're looking at $7 trillion, Daniel, of cash on the sidelines right now. $7 trillion. Think if $1 trillion of that comes off into the market, if rates start to go lower, that's going to dramatically push the S&P higher. Just it's going to have to go higher because there's only so many stocks out there. There's so much money and there's too much money going into stocks that are going to push them up higher pretty quick. So I'm very bullish.
Vance, I think that's the largest price target I've heard from anyone so far. You said double over 36 months?
I think, well, look, I'm not saying it will. I'm saying it has the potential to over 36, 48, 5 years to double. Mm-hmm. And if you'll remember back in the 90s, there was 3 years in a row, the market was up 30% plus. When you compound that, you had a doubler. So it's happened, and I think it can happen again.
All right, Vance, that's a great note to leave it on. Let me say, we all hope, obviously, it comes to fruition. Vance Howard, everybody, CEO and portfolio manager at Howard Capital Management. Today, we've been talking about the QQH ETF. Make sure you add it to your portfolio, your watch list. Check it out, and we'll see you next week here on ETF Spotlight. Take care.